what? All the best investments, they're simplified down just to 2 points, basically. If it's any more than that, it's too complex. Like Macau casinos, just a simple bet, asymmetric bet that they get their license.
Yeah.
JD.com, just a bet that their cost advantage allows them to continue to grow their profits. That's it.
This continues the interview series. Our guest today is John Qiu, who's been in the investment industry for the last 15 years and is in the process of setting up his own fund. Our audience is the aspiring practitioner, individual investor, or someone who wants to pursue a career in an investment, or you could be someone with general interest who wants to learn about investing. So, John, thanks for joining. Excited to have you today. Can you tell me a bit about yourself and your career today briefly?
Sure. Always happy to have these interviews with you, Brendan. So I started out back in 2007 in August with a fund manager called Orbis Australia, which is now called Allan Gray Australia. So it was originally set up by a South African Allan Gray investment head of investments, a guy called Simon Moraes, and I joined his team roughly a year after he set it up. And originally I came in on the investment relationship side, but given that it was a very early stage fund at that time, I did both investing and relationship management. And I transitioned to a full-time analyst roughly a year and a half after joining. So Allan Gray Australia is a very deeply contrarian sort of manager, and I think that forms a lot of the foundations of what I do today. And I worked with them for about 4.5 years before eventually moving to Hong Kong. And I worked for another fund in Hong Kong called Overlook Investments for about 7 years, which is also very similar, a boutique sort of fund, but very concentrated, less contrarian, but very fundamental based, also with a very long sort of track record. So about 2 years ago, I left Overlook for personal reasons, to start a family specifically, and I'm expecting to open my own fund next month, actually.
It's pretty exciting, John. Guess it might be a good time to talk about your approach and what's your philosophy. So, John, can you tell me a little bit about your investment style?
Sure. So my investment philosophy is influenced by both my experience at Allan Gray Australia and Overlook Investments. So at Allan Gray, we tended to be very, very deeply contrarian and fundamental based. At Overlook, it was slightly different in that we were looking at buying quality companies at reasonable valuations and investing in them over longer time periods. So there was much less of the cyclical investments or investments where we expected mean reversion within a 1 or 2 year time period. And I think my own investment style incorporates both of these aspects. So I typically will invest in two types of companies. One is the ones that have been heavily hit by very negative news, or they are at the trough part of an industry cycle. And the second type of company that I typically invest in is companies which I think are fantastic quality operations, which I believe can compound over many, many years, given the strength of their business.
Okay,
and I guess the last thing to add to that is my portfolio is very concentrated. So typically I will only take 15 positions or ideas, which is more aggressive than your typical fund.
Okay. We'll get to the portfolio a bit later. Just wanted to come back to the two scenarios that you like. You were saying your first company was more contrarian, and then the second one was trying to pick up undervalued investments, but not looking for mean reversion in 1 to 2 months. Is it more longer term?
I think with the first basket of companies, they're almost a pure contrarian mean reversion sort of bet things, which is very appropriate for markets like Australia and South Africa, where there's a lot of cyclical commodity-based companies.
Okay.
For the second type of company, I think this is much more common in Asia, where these are maybe niche or maybe big companies with significant barriers to entry. And often you can buy these at very reasonable valuations, and they do a very good job of compounding and growing their business at a very, very fast pace. So we can talk about examples later. But I guess the difference is between Australia and the Chinese market that I found was there are actually a lot of things in Hong Kong and China which are extremely, extremely cheap. And if you just come from Australia, you'll say, wow, I'm buying this thing for 20% of book value. But a lot of these things don't ever mean revert. And some of them are frauds. Some of them are because of management reasons. So you cannot adopt a pure deep value approach to the Asian market like you could for Australia or developed markets.
So then would that imply the Australian market is more efficient in a way?
Not necessarily. I think Australia is 1/3 mining, 1/3 banks, and 1/3 everything else. And the mining part, just by its nature of prices, iron prices high, iron prices is low, and the market prices those companies accordingly. But in China, these resource-rich companies are far rarer, so there's less of those cyclical sort of companies, and there's a far greater number of consumer names, internet names. So the structure of the market is also very different.
Okay. Just coming back, last question on this contrarian approach, but can you define it? Because my understanding of contrarian is just taking a view that's different from the majority.
Yeah, sure. So I think investing is a zero-sum game in that if you add up all the fund managers together, that entire portfolio would roughly look similar to the index. And then once you take out the fees, then it's probably underperforming the index by whatever the average fee is. So a contrarian approach is basically the belief that if 10 fund managers were to be put in a room and 9 of them said, we like this stock, okay, and then one guy says, I don't like this stock. The 9 that like the stock have already bought the stock and repriced it according to their expectations, okay? So contrarian approach is basically saying, by going with majority, you're a price taker of all the expectations. It's only by being a minority that you can find investments which are outsized performance or which can beat the pack, the rest, the remaining investors. I think being a contrarian also for the funds that I worked at and for my current approach is a necessity. Because, in the investing game, you're either quicker than everybody else, okay, or you're better at executing trades than everybody else, or you have a different sort of mindset to everybody else. So I don't think I'm faster than everybody else. I don't think I execute trades better than everybody else. So what I try to do is I try to exploit market fears or market attention spans. So market may be fearful of an event for the next couple of months, maybe even year. But after that, maybe that asset's true intrinsic value is not impaired. COVID situation was a perfect example. The market sold off heavily, okay, and we're still experiencing the negative economic effects of that. But in reality, a lot of these companies, their values over 1 year, 2 year time period is not negative 50% or negative 60%. So I think contrarianism is just, stepping back and considering the data and thinking where the market may be mispricing companies or assets.
Okay. And then, so would it be possible that you don't necessarily have more or additional information than the market? It's the edge is in the psychological interpretation of short-term behavior?
That's right. That's correct. We use public information, but the attitude that we have or what we're looking at and understanding is very different to the market. And I'll give you a quick example. So back in 2008, Orbis Australia saw that the REITs had sold off at a massive pace. And, these things had gone from 1.2 times book value down to 50%, down to 10%, even 5% in bankrupt for the likes of Century retail assets. And so, it's not that we disagreed that these things were over-levered and that the tenants many of them were going to go bankrupt, or that there wouldn't be significant pain in the entire sector. But we also thought that given Australia's prime retail assets were all owned by REITs, given that banks were heavily exposed to these assets, if the banks foreclosed on all these REITs, then Australia's banking system would be destroyed, right? Australia would have massive issues. So what we did was we bought a basket. We pretty much bought every single REIT which was cheap. We bought them from 50% of book all the way down to 5% of book. And our thesis was, even if we get 4 out of 5 incorrect, the one that survives is going to pay for all the rest. And I think that's exactly what happened. There was a massive amount of fear that individual names was going to go bankrupt. But in the end, all these things, by 2009, 2010, had been reverted back to book value. So that's an example of where you may agree with market in some of these views, but I think the market is missing, what's the saying? Missing the forest for the trees.
Right. But then that is fairly sophisticated, that strategy that you applied there. So in a way, it might be understandable.
I'm not sure it's sophisticated or not, but I think it's just different. Like, people would sell and hope to buy things back later, or they had pressures because of redemptions from clients. It requires a certain type of risk appetite and a certain type of investment philosophy to be able to buy these companies and not get fired from your job. I mean, I couldn't think of another fund where the fund manager dared to buy these things at the pace that we were buying. I mean, we loaded up about 20 to 25% of our portfolio with these assets, which everybody thought was going to go bankrupt.
Right.
We could do that because the PM had such goodwill from his clients, had so much of his own money in there, and just saw the huge asymmetrical risk payoff from these bets that we could do that. But in other places, you're remunerated based on 1 year results. If you get it wrong for 1 year, you're out of there. So I think the structure of the business that you're in also determines the risks that you're able to take, which is why I think my investment philosophy will only work if I structure my fund in a way that allows me to take these types of bets and investments.
That's very insightful. You want to exploit, I guess it's a structure or something that's baked into the industry that I guess incentivizes short-term behavior. Okay.
That's right. That's right. And, majority of finance industry is based on short-term behavior. I mean, how does sell-side research get paid? They get paid by the commissions that they generate. And the more transactions you do, the more commissions you get. And so analysts are always fighting to be the more accurate in predicting what next quarter's earnings will be or what the economic state of a world will be like. And by nature, people like to follow the herd. And so there's a lot of investors and funds which follow that sort of advice. But I think to be truly exceptional, then you have to do something that's a little bit different. And a lot of times you just cannot have the same sort of a investment pattern as the rest of the pack.
Okay. I know we have a couple of case studies to get to later, so just a couple other general questions. So on the second approach that you favor, sort of categorizes you as a value investor in a way, and you were saying you don't just go for deep value, you want to do more than that. So how do you avoid getting into a value trap or identifying a catalyst so that the stock doesn't remain underappreciated? Yeah.
You're right. I think one of the pitfalls of having a deep value attitude or contrarian attitude is that you'll get some things wrong. And I think by and large that's unavoidable. And I've had more my fair share of these failures. But it's interesting, I think at Orbis they did a study where they found that to maintain an above average track record, they only required a hit rate of about 60 to 65% success. Okay, you could be wrong on the remainder and you could still generate very, very good alpha. So point one, I guess, is that it's often very hard to avoid these sort of value traps. I'm going to try and improve on that by the sizing of my positions. But I fully expect to be caught out in many of these value traps. I guess the second thing is in Asia, I don't try to be a deep value sort of player. If something's really, really cheap in Asia, then there's usually something very, very wrong with it. And so understanding the business well usually allows you to get a certain degree of comfort on what that issue could be and whether the thing is just an outright fraud or not.
Okay. And on to, I guess, the maybe last question, general question. You've said that you're not a macro investor. Does it play a role at all in, the selection of your investment? And I guess this touches on portfolio construction as well and appetite for risk.
Sure. I don't allow really my macro views to dictate how I invest. So it's not like I think, wow, the world is moving towards green energy and therefore I've got to get exposed to green energy companies. Instead, my viewpoint and my understanding world is formed from the individual companies that I invest in. And understanding companies allows me to see certain trends that are happening in the market. So I always think of the world from a bottom-up sort of perspective. But that's not to say that I won't, have a tendency towards wanting bigger exposure to certain types of risks. For example, I've been worried about inflation for a while now. And so I've tended to want exposure to companies which will give me real returns. And it just so happens that there were many investments which fell into that sort of category. And my allocation towards Chinese companies was not because China as a whole had cracked down on internet. It was because I knew these companies from many, many years, knew their operations well. And at a certain point in time, I thought that the risk that they were facing versus the value of their business was just too attractive to ignore. And so I started buying these. But if you ask me what's going to happen, what the next sector is that the government may target, I really don't know. And hopefully by having a diversified portfolio, I can avoid majority of that risk. So I've been lucky that I haven't had any direct exposure to any of the major sectors which had been heavily hit, like education, gaming, or local services, ride sharing. These sectors were probably among the hottest sectors, investment sectors, just a few years ago. Everybody was jumping on board and salivating at with high growth rates. So I avoided those simply because they were too expensive for me and I didn't think they were sustainable.
Okay. And then you've said you've got a very concentrated portfolio. So then the threshold for a new investment must be fairly high. How do you, I guess, contemplate that?
Yeah, sure. So at Overlook Investments, the threshold for putting in new investment was an IRR of 15%. And that was roughly the net of fees return of a portfolio for the last 25 years, 22 years. So I have a similar IRR, but I think my IRR changes depending on the type of market that we're in and also what's already in my portfolio. So whatever new that comes in the portfolio has to fulfill a certain purpose and offer a better risk reward than what's already in the portfolio. So I think that part is dynamic.
And then on the downside, do you have a tolerance for how much it can go down before you cut your loss, or how do you think about that side of it?
To be honest, I don't think I'm very good with that part. Often I have conviction in idea, and when it falls, I think, wow, this is cheaper, so I should buy more. I think that is one part which I'm changing now. Firstly, because it's painful to buy into positions and get it wrong and lose, but also because I'm training a batch of new analysts now to join my fund, and when it's somebody else doing the research, then instead of taking bets, high conviction bets on the asymmetric sort of payoff, you also got to consider the hit rate of the analysts themselves, right? So I'll rather take a standard size bet with each of these analysts, work out what their hit rate is, rather than misestimating that number and losing money in the portfolio. So I think for me right now, the standard position, given 15 names, is a 5% position. So if you work it out, 7% is full, 7% times 15, but you want to leave yourself a little bit of maneuvering room, right, for the stock to grow into that position. And so I tend to think of 5% position increments, and I'll allow them to grow depending on what the upside of that idea is. So for example, currently the largest position within my portfolio is around about 18%, which is quite concentrated, but it's an idea that I have very deep belief in, and I think that it's one of these companies that will compound massively over time. And I'll talk about that company later, actually. It's JD.com.
No, that's great. Thanks for sharing, your general approach and a lot of these details about, I guess, how you think about portfolio construction and investment. We can probably move on to those case studies. So yeah, it's good that you mentioned it. So whichever you've mentioned that you want to maybe discuss too.
Sure. So I'll talk about JD.com. So currently, as I said, it's the largest position in my portfolio, about 17 to 18%. I first started looking at JD back in 2016. At that time, I was predominantly occupied with consumer stocks, understanding brands, understanding distribution. And it just so happened that we had a very small team at Overlook, only 5-6 people. So everybody was generalist, and I was in Beijing and I decided to see a lot of companies, and I thought, well, to understand these consumer stocks better, I should actually talk to the companies that are selling these goods. So I met with JD.com, and I started off from a very, very cynical place. I mean, this is a company that was losing money. It was negative margins for internet business, and I just didn't understand it at all.
Okay.
But when you actually look at the company, I think there's a couple of things. Internet analysts do not understand JD or e-commerce players that well.
Can you give just a very quick summation? Is it like the Amazon of China, or what's the basic mission?
JD is much more like the Amazon China than Alibaba is, but it's less well known. So JD runs a 1P business, which is direct sales. So like Amazon, they'll directly buy from the brands and then sell it to the consumers. And then they also have a 3P business or a marketplace business where merchants will put their goods onto their platform, and then JD gets a commission cut. For Alibaba, it's a little bit different. They run almost purely a 3P business. So they take merchants and they take a commission cut of that. So JD started off with primarily doing electronics, and then they moved on to other categories. So they're doing a lot of homewares, clothing, and now moving into foodstuffs, fresh foods, pretty much everything you can think of, JD would sell.
Okay.
And they're the number 2 largest player in China. So I think Alibaba is around about 50 or so, 50 to 60%. JD is about 20 to 30%. And then Pinduoduo's, you could call 15 to 25%. It depends on your definition.
Okay.
Because Pinduoduo's GMV, I'm not sure all that's real. Okay. So I think you would classify JD as probably the second largest player in e-commerce in China.
Okay. And you were saying that investment analysts didn't understand the business.
Yeah. So I think the typical investment bank would hire people to look at internet stocks, right? Or people to look at consumer stocks only. Okay. But to understand JD, to understand Amazon, those type of business models, I think you need to also come from the retailing side. And I was fortunate enough that I was looking at consumer companies at that time to understand that. So I think a few key features is, firstly, internet platforms like JD and Walmart and offline retailers, they all run a negative working capital, meaning they sell their goods. It takes them about 2 weeks, maybe a month to sell their goods, but they don't need to pay their suppliers for 2 months or even half a year in the case of white goods or electronics. So what it means is that your manufacturers are actually bankrolling you when you grow your sales. Okay. Second of all is that these businesses tend to be much more efficient cost structures than offline retailers. Offline retailers have to pay rent on their stores, but also they have to pay a lot of salespeople to sell those goods. And in the case of supermarkets, you also have a wastage cost involved as well. But with online, you don't have those sort of costs. You have, IT guys to make sure your websites are updated, etc. But there's a massive amount of savings involved in that. And also the logistics that gets the product from a manufacturer or the field to your door is much more efficient for online platforms. It's because, one, they are shipping almost directly from manufacturer to warehouse to your goods, unlike an offline retail which needs to ship it to the warehouse. The warehouse needs to ship it in the store. They need to keep enough inventory in the store to cater for potential people buying of certain products. Online, they can keep a much smaller inventory, okay, and they have much larger volumes of data. So they only basically need to keep a very small inventory relative to an offline sort of player. So when I started analyzing JD, I read up on the history of retailing for Walmart and for Amazon. And I realized that their negative working capital model allowed them to do a very aggressive sort of market expansion sort of strategy. And what I did with JD was I compared their cost structure relative to the offline majors in China, which at that time was Sunart, Gourmet on the electrics side, and Suning, Yonghui Sunart and Yonghui on the supermarket side, Gourmet and Suning on the electronics side. And I did a combined sort of thing. And if you put all this cost structure that I talked about before, JD was probably cheaper than them back in 2016, 2017 by about 5 to 7%. 5 to 7%. I think that cost advantage has probably grown to about 9% today, given how much JD has expanded their logistics part, and also because Suning and Gourmet basically gone bankrupt now. So you're competing against much smaller stores today. So that sort of cost advantage is something that you develop over time, okay? And even though they were losing negative 3% in margins back in 2016, they were gradually getting more and more customers on board with their platform. And user habits tend to be sticky over time. So once you start buying goods from somewhere and you get used to buying your electronics from certain goods, you tend to go back to that place and buy more goods. So one day you might buy an iPhone, next day you might buy an iPhone plus a TV, and then so on and so forth. I mean, those user behavior patterns are pretty established. So with JD, they were actually able to continuously increase the cost efficiencies in their back end, and at the same time reprice their goods slowly, a little bit by a little bit upwards. So right now in electronics, you actually find that the prices that they charge for their phones or their TVs is actually not that different to offline, but they're making so much higher margins than because it's so much cheaper for them.
Yeah,
So back in 2016, that's the business side.
Okay.
The value side was you're basically paying 0.2 times GMV, which is gross merchant value, okay, which is basically your equivalent of revenues for a retailing business. And so you're paying 0.2 times GMV, okay, and I thought that they're sustainable margins, assuming that they were always 3% cheaper than offline. The sustainable margins was, by my estimates, between 3 to 5%, which implies you're paying about 10 to 20%, 10 to 20 times on a price to earnings basis, normalized price to earnings basis, for a company that at time was growing at 40% each year, which seemed to me to be crazily cheap. Unfortunately, however, I didn't manage to get that stock into the previous fund that I worked at. But I had a second chance to buy this after I quit my fund because of the founder's rape allegations in the US. And after those rape allegations came out, which later turned out to be false, the stock price dropped to as low as, I think, 20s in 2019. So I managed to take a very large position, which has grown to what it is today.
That's very interesting. So all that research that you've done in previous years, I guess it's preparation for the right timing. Yeah.
I guess just add a couple more comments to that. I think JD was a very controversial idea, less controversial now, but I still don't think that the market understands it very, very well. I think that back then the argument was Alibaba will just kill this company. Why would I buy a JD when I could buy an Alibaba, which is generating all these fat margins, right? But they were never apples to apples, pairs to pair comparisons. And second of all, the story was never JD versus Alibaba. It was always about online disrupting offline. Back then, online was only 15% of total retail sales. That number's gone up to 25% now. It doesn't matter that Alibaba was growing. So what? JD and Alibaba combined was taking massive market share from the offline guys. And as you've seen by the new policies in China, Alibaba is no longer allowed to do those anti-monopoly, anti-competition practices which they engaged in the past. So in the past, back in 2016, JD was already complaining that Alibaba was telling brands that if they work with JD.com, then they're not allowed to work with Alibaba. I mean, that kind of thing just doesn't fly in any other sort of market. But they were allowed to do that in China for many years because Alibaba had so much political and market power.
Yeah, no, that is interesting, the regulation angle. For people that aren't as close to like the Chinese market and I guess like myself, it does sound like it's it's like a category edge for online against offline. So you know how you said it wasn't an apples to apples comparison between Alibaba and JD. It sounds like that, and maybe the Australian analogy is like, Kogan or against Harvey Norman or something. Is there additional reasons for JD over any company that's just online disrupting offline?
Yeah, so I think, first of all, there are only three major general online retailers in China, and that's Alibaba, JD, and Pinduoduo. Okay, so after the crackdown on Alibaba early this year, I've also taken a position in Alibaba after its stock price fell below its IPO price. Okay, but the number 3 player, Pinduoduo, I'm still not convinced that their business model is viable. They remind me of the flash sales sites that was rampant in Australia, back in 2015 or so. Catch of a day, all these other things. Really, really fast growth, except I'm not sure that user habits of recurring purchases is necessarily built on that sort of a business model. Now, Pinduoduo is trying to evolve into something that people go back to buy goods, but I think the jury is still out whether they can take away their incentives and continue that sort of user behavior. So I think what you're buying when you buy JD is an extremely high quality business, which has built a massive back end of logistics, services, of all these different things. And I think that JD is actually helping a lot of regions, employment in lower tier cities, your previous migrant workers, which built roads in Shanghai, Beijing, etc. that workforce has to evolve into different areas. And I think e-commerce is definitely one of the areas which is hiring that kind of workforce. So I don't see it as being negative for the country as a whole. Sorry. Now, your original question was, what about other businesses where online is disrupting offline? I think the biggest difference is for e-commerce like JD, the barriers to entry are just rising day by day. It's almost impossible to replicate their cost structure if you were to start a new e-commerce business in China today. Building more warehouses, building up supply chains, getting your merchants on board, that requires a massive amount of capital spending and network. So I don't think that there will be any new competitors. But, all other hot sectors, including education in China or software as a service, the one thing I can't really get much clarity on is the competition side of things. Education things. Almost anybody was starting up a new education firm just by hiring up a local place, finding a couple of high school teachers who wanted some work after hours, and then voila, you have an education company, right? Or just copying whatever material was already online. And software as a service, I'm sure many of these companies could be very strong, but gosh, there's so much competition from new startups, from existing players, that it's not clear to me exactly what their margins will be in the future and who will win out of that sort of process.
So I guess maybe final question on JD. It does sound compelling, the barriers to entry and quality business. It sounds like an analogy to Amazon. If you could pick, a year that ties it to Amazon, would you say it's somewhere like 10 years after, maybe 2010 or something, in terms of how much it's yet to run, like on the upside? So there's been a general sell-off in Chinese markets, but I guess with your high conviction, where would you place it in terms of how long you could hold a company like JD?
Yeah. I think the start, JD in 2016, was very early days Amazon's, so early 2000s Amazon. But today it's much harder to place JD's exact positioning because the Chinese companies have actually gone a very different route. For example, in China, I don't think JD could create the cloud service like Amazon did with AWS, simply because Tencent and Alibaba is so dominant in cloud services. But instead, JD has gone down the route of doing online pharmaceutical sales, jdhealth.com. And it's also trying to utilize the excess capacity within its logistics business, creating JD Logistics. Dada is their last mile sort of platform for deliveries, etc. So I think it's much harder to draw direct comparisons in time with Alibaba, with Amazon. But I think with JD, the trend for e-commerce is probably still in the high teens to 20% sort of range for the next couple of years. And I think that if you take their listed businesses right now, put, say, a 20% discount on their valuation, and then you take out some of their unlisted investments at the last funding round, then you say that normal margins for the e-commerce business is between 3 to 5%, then roughly what you're paying for JD, the core business itself, so just the JD e-commerce platform, is something in the range of 10 to 17%. So low double digits to high teens. And I think that e-commerce business growth is still going to be very attractive for many, many years. And I think that JD in the future and Alibaba will start opening more and more offline stores, just like Amazon is doing with Whole Foods and these other things. So I think that the marriage between online and offline will actually start from online side. So I think the risk reward for JD is still very, very high, but I just can't give you an indication how to compare it to Amazon.
Oh, it's a very kind of general, tough question. So thanks for doing your best to answer that. So maybe we can move on to the next one, or do you feel like maybe we take a quick break? Sorry, we're running over a little bit. You're happy to spend a bit of time on this other?
Yeah, no problems. It's lunchtime. Shall we continue?
Yeah. Why don't you just jump in?
Sure. So your viewers might be interested in some recent ideas. So I think there's one of the things that's happened this year is that people become extremely, extremely fearful on China. And, and fair enough, it seems like the government's doing reforms of many different sectors. And so since Alibaba started falling, we've seen hits on education, gaming, liquor companies, property companies. And last week, even Macau casinos got massively sold off. So last Wednesday, the Macau Gaming Commission said that they were going to start the process for renewal of these gaming licenses. So as some background, in 2002, the Macau government granted these licenses for 20 years, and those licenses are expiring in 2022. So anyway, they said that they're starting a 45-day process, and they listed 9 areas which they wanted to explore with both the gaming operators and with the public. So just a general sort of announcement. And the casino sold off 40% on that news. I think the reason why was among the 9 different areas, one was the duration of the contracts. So instead of 20 years, it's probably going to fall to 10 years. Okay. Second one was that the government was thinking about putting government representatives inside the casino and also onto company boards, and having the government have a final say in dividend payouts. Okay. So I think the market is extremely fearful that what this means is that the government will start really cracking down on the VIP clients from mainland, who the junkets were facilitating. So China has a tight capital control, and theoretically, you're only allowed to transfer $50,000 US dollars each year. But VIPs get around this by using junkets who lend them money overseas, and they repay them back in the mainland. So I think the market's fearful about that. And also, I think the last point is there are currently 6 license holders, and so 6 license holders, 2 of them are direct license holders, and 4 of them are sub-concessions. I think something like that. But anyway, for all intents and purposes, sub-concessions are same as normal license holders. But the government said, well, we want to reform it so that there's only license holders. And so the market is taking the negative view that this might mean a couple of these operators will get kicked out of the market. Okay. So anyway, these companies sold off about 40% last week, and they've stabilized now, but for the likes of, say, Sands China, Sands China is down to 2010 levels. So it's down roughly half of the market price since last year, and it's about 1/3 of the market price in 2019. Okay, and same thing for Wynn. So the market is extremely bearish, that thinking that these two companies are majority US owned companies, and that they could potentially lose their license. So I think that Macau, the market reaction to this news has been significantly pessimistic about the whole thing. First of all, these issues which the government had raised are nothing new. Like, I remember talking to the companies about these issues years ago. Okay, nobody thought that the license would be renewed for 20 years. Everybody was doing charity or helping integration with China on Heching Island and all these other things. These companies had been fantastic corporate citizens over the past year, when basically their operations stopped entirely. They hadn't really laid any people off. They supported the government's vaccination drives. So I think the risk of any of these guys losing their licenses is actually very low. And you've got to remember that the government policies in both Macau and China has been towards integration of Macau and Hong Kong into the Greater Bay Area, right? And they've done a lot of good things towards that direction, establishing tax-free zones, doing a Wealth Connect program, Bond Connect program from the southern cities. I mean, sorry. For them to take away any of these guys' licenses would be a huge blow in confidence towards that greater plan of having more capital to develop and helping integrate Macau. And, between Macau and Hong Kong, Macau has been far more friendly towards the Chinese government plans. So I don't think it makes any sense that any of these guys will lose their licenses, which is not to say that some other parts of this reform will not be enacted. Okay, so quantitatively, what are the Macau casinos trading at today? So if you use normal earnings between 2017 and 2019, the Macau casinos are trading at, as a whole basket, all 6 of them, is trading at mid to high double-digit free cash flows. Or on a PE basis, they're high single digits PE. Okay, and all these operators had just finished their recent round of capex spending, so building their brand new resorts in Cotai. So actually, their capital needs for the next couple of years is actually very, very low, which means their earnings is understated. Okay, historically, and even now, the Las Vegas casinos, overseas casinos, tend to trade in the high teens to 20% range. Okay, so if they revert back to overseas multiples, then as a basket, these casinos should double.
Okay.
Which is also similar to the stock prices that you see, but a little bit more extreme for Wynn and Sands. If they mean revert to 2019, then you're roughly getting 2.5 to 3 times on the upside.
Hey, does Wynn have a US presence?
Yeah, it does. So it's called Wynn Resorts, and they own Wynn Macau, which is the Hong Kong listed entity for just the Macau casinos.
Oh, okay.
A lot of these US operators have actually divested their US gaming assets because the Macau and Asian assets have just become so profitable that it makes no sense for them to keep their US ones.
Right.
That's not the case for Wynn.
Okay. Can I jump in with a couple questions?
Oh, yeah, sure. Just let me finish the quantitative part.
Okay.
So if you use the mean reversion to 2019 sort of levels, and you assume the downside for Sands is basically 10% of current valuation. So you value Sands at $2 billion. Okay, by the way, $2 billion was what they spent on their first casino like decades ago. Like, I think it's massively underestimates their liquidation value. But anyway,
you're saying downside is 10%?
90%. If you assume downside 90% for Sands, and for Wynn, you assume downside is you get nothing back. Okay.
Just making sure I heard you correctly.
Sure. If you use those numbers, okay, mean reversion, if they retain their license, they mean revert somewhere close to 2019 levels, and the downside is 90% for Sands and 0 for Wynn. Okay. The neutral bet, okay, so the expected value equals 0 sort of bet implies that these guys only have to win 37% of the time, meaning they could lose their license 67% of the time, okay? 67% of the time, their value goes to 0 or just 10%, and your bet will still be positive.
How did you get that number?
You just take the probability of upside plus upside times the return plus the probability of downside times the downside return.
So what
equals 0?
Are you placing on upside probability?
So it's just very simple algebra. So upside is 2.5 times roughly for Sands. Okay. And if you do 2.5 times x plus 2.5 times 36%. Plus 0.1, okay, 0.1, which is the downside, times 1 minus x, 67%, okay, that answer is roughly 0.
Okay, so I think I follow. The upside, the probability comes out from balancing the upside to the downside.
Yes, exactly.
Okay.
So, quantitatively, you're basically saying that there's 67% chance that these guys would lose their license. And for me, that sounds like a ridiculous evaluation of the current situation. Secondly, you can use Bayes' theorem to assess the materiality of last week's announcement. The stock price fell roughly 40%. Bayes' theorem is basically saying that the market thinks that this type of negative announcement, okay, is more likely in 3 times the cases. This type of announcement in a negative outcome scenario is 3 times as likely as in a positive outcome scenario. So it's saying that you would see this type of announcement 3 times more in a negative scenario than a positive scenario. And I think that's just rubbish. I think this kind of announcement would have been made in any sort of tendering sort of process. So I don't think that this announcement was material at all, given. Go on.
I was just going to say that downside being 3 times in effect size, is that based on historical data?
Yeah, it's based on historical data.
Other companies.
It's an oversimplification, okay, because it may not revert to 2019 sort of levels, but you can take any number you feel comfortable, right? And you'll still get a very high number for required win rate, okay? So I think this just goes to show how asymmetrical the risk-reward payoff for these companies have become, okay? And additionally, Wynn and Sands are the best operators in Macau. So if you look at their data, and you've been to their casinos, Sands has the largest portion of mass premium gamblers. Mass premium gamblers are those people who like to stay in 5-star hotels, like to gamble, spend on amenities. So the Venetian and Sands Cotai resorts are extremely good at attracting that sort of crowd. And that's why you can see that from their gaming statistics and returns on most properties are extremely high. And the ability for them to keep gamblers interested and stay in their resorts is also extremely high. So I think Sands has the best premium mass product, and then Wynn has the best VIP sort of product. So I think you're buying two of the best operators in Macau, taking very, very long shot odds that they'll lose their gaming license. I think that the outcome will either be zero, almost zero on the downside, okay, lose all your money, or you're going to get 2 to 2.5 times return within next 45 days or so. So I like the odds of this investment, and also I like the fact that the risk profile of these investments, which is purely tied to regulation, I think that risk profile fits extremely well within my portfolio. If interest rates or China or COVID or all these other things hit, it won't directly affect the outcome of the gaming regulations.
Yeah, no, that's very interesting idea or investment.
So I think it's a little bit different to your typical investment pitch, because what I'm doing here is I'm framing it in terms of gambling mathematics, right? You're betting on a horse that gives you 3 times on the upside, or it could return 0, okay? And you just have to be confident that the horse doesn't lose 67% of the time, right? This is a very loaded sort of coin. And furthermore, you have a lot of information on that coin. And qualitatively, I think that coin is very, very likely to fall in your favor. So that's an example of a contrarian investment that I've made recently.
Yeah, no, it sounds quite contrarian. Can I ask a few questions, probing questions? So I guess maybe the first one is just a comment. It sounds like a valid concern that, if the Chinese government want to put an official onto the board and potentially restrict capital, flows for VIPs, that seems kind of valid. The other point that you mentioned was...
Yeah, look, I agree with you on VIP part, but VIP and anti-money laundering crackdown has been happening since 2013. So VIP gross gaming revenues, I think, peaked at 260 billion in 2014 or so. I have those exact numbers somewhere. Anyway, it doesn't matter.
It's okay.
But back in 2019, the VIP was already down to 135 billion, so it was already down 45%. So the Chinese government has enacted those things, like, for example, you can't use money transfer mechanisms. Union Pay was not allowed. They started putting AI surveillance cameras at ATMs. Like, most of those things have already happened. Now, obviously, having Macau officials inside those casinos will probably make an impact. But at the same time, Macau's economy is almost purely dependent on gaming. I mean, whether or not they enforce it to that degree is questionable.
They have incentives not to enforce it. That's strictly.
Sure. Like, Macau government's annual budget is 85 billion MOPs. Okay, that's how much they spend. In 2018, they got 110 billion MOPs from gaming. Okay, and pretty much the whole consumer spending and the domestic property, everything is tied to gaming. Okay, so I don't think it makes sense for them to kill the gaming industry, which is what they'll do if they stop one of these licenses. And also, even in the worst case scenario, right, that their negative policies, somehow stops visitors coming, etc., and gross gaming revenue falls 30% from 290 billion in 2019 down to 200 billion. So 200 billion was probably the gaming revenues, I think, back in 2012 or 2009, somewhere like a decade ago. Even in that sort of scenario, you're paying roughly high teens multiple, PE multiple, for all the casino operators added together. So right now, for casino operators who buy every single one of them, it's about 40 to 45 billion US dollars, right? You're paying like high teens. So you're getting that 7% yield on it, which is back to the valuations last year, right?
Okay.
And the fact is, if a government takes away one of these licenses, it just means one of the other guys gets a bigger share.
All right, point taken.
So, I just don't see the negative,
No, I could see the arguments for just probing like the devil's advocate side of it. The other one, I might have missed this detail, was the 45 days. You were confident that it would, the outcome would be determined within 45. Is that due to another announcement being expected, or what's behind that?
I think at the end of the 45-day process, there will be more clarity on what the government intends to do next. Okay, so I think Macau casinos will have two stages of repricing. One is when there's more clarity on who will get the licenses and when. This will affect Sands and Wynn more. That will probably occur within 45 days, maybe a bit longer. Maybe government has time to deliberate. Okay. The second part of the repricing story, okay, for Macau casinos would be when the COVID situation changes, or once we get more data from the Golden Week period. So China has a massive national holiday in early October. Depending on the traffic numbers there, you could see a big sentiment re-rating for Macau casinos.
Are there restrictions in place for Chinese to visit Macau?
Earlier this year, they actually lowered a lot of the restrictions for cross-border in Macau. But then there was an outbreak in Fujian recently, so it's not certain what's happening there right now. Okay, but so far this year's traffic has been relatively good. Yeah.
Okay. Final question on the casinos. So I know you don't weigh the macro situation as heavily, but it's hard to ignore the sell-offs in those other industries, gaming, technology. And so general appetite for Chinese stocks is probably not great with high levels of fear. There's been the announcement of Evergrande having difficulty making repayments. You would think that's a large driver of the sell-off as well. So you've got the new information in the announcement, set against that context. So I guess the question is shouldn't that factor in some way to explaining the recovery as well? Not attributing all the price action just to the announcement.
So you mean an improvement in sentiment towards Chinese stocks?
Well, I'm just saying the way you framed the risk reward was the sell-off was fully attributed to the regulatory announcement, right? The approval, rather than attributing some of it to the negative sentiment in Chinese stocks. So then on the upside, on the way back up, should some weighting be given to the fact that you have persistent negative sentiment that may not recover? So then even if what you suggest plays out in the way that you've described, it might not rebound because of there's more of an appetite, macro sentiment attitude to stocks in China.
Yeah, so you're right. There is some negative sentiment impacting these stocks. So prior to the sell-off on the Macau announcement, I think Sands stock price was around $26 and it'd fallen from 30. So maybe, 20% of 20% of the prior to that was related to negative sentiment. So yeah, maybe that part plays some factor in a mean reversion sort of thing. But at the same time, I think markets generally have a very short-term sort of memory, right? So I think for what I do, I try and evaluate what's transitory and what's permanent, okay? I think permanent things would include people's propensity to buy goods online, people's propensity to seek entertainment. I think it's universal in China, US, everywhere. Okay. I think when these companies eventually recover back to normal sort of levels, investors will be attracted to the growth and the returns of these companies. I mean, if I'm telling you, you can buy this company, okay, that's got no more regulatory risk, okay, and it's yielding double-digit free cash flows. I mean, I would have thought that a lot of investors would be buying back in. And as for the China risk being a permanent impairment on their valuations, I honestly do not buy that at all, because the valuation gap between Chinese companies and overseas has just become too big right now. And we keep on thinking that the pricing of assets comes from Western capital. I don't think that's necessarily true over the next 5 to 10 years. More and more, we're seeing an active role and capital coming from Chinese investors via Southbound, via the new stock connects that they're participating. Think about it. The Chinese investors had only been allowed to invest in domestic property and domestic Asia previously. But now they can buy Tencent, they can buy Macau casinos via stock connect. Why wouldn't the capital that's coming from them lead to a repricing of these sort of assets? I think that in general, capital globally flows towards highest returning assets. And I don't think that the Chinese living in Hong Kong or in mainland or anywhere in the region, to be honest, is as negative as US-based investors are. So I think I'm relatively optimistic that the mean reversion in terms of sentiment will happen, and that this is not permanent.
Yeah, it could very well be fear of uncertainty and,
Yeah, look,
not
right now we're seeing the Fed taper, right? If NASDAQ drops like a stone, okay, on a relative basis, would you rather be in China with 3.54% interest rates, normalized monetary policy, okay, and buying something with double-digit free cash flows? I don't know the answer to that, but I'm just saying that I think there is a lot of risk everywhere in the world, and on a relative basis, long-held beliefs will shift quite quickly.
It's very possible. I think it's basically a belief in institutions, and you living in Hong Kong would obviously color your beliefs, and it's the same for investors outside, of Asia. But it's a big, I don't know, it's an unknown, a variable.
Me living in Hong Kong has influence on my views, certainly, because I see these companies more. I know a lot more about these companies, and maybe I'm overconfident on them. I don't know. But when I look at the global opportunity sets, okay, right now, there is a massive, massive valuation difference between an asset in the US versus an asset in China. For example, I bought oil and gas stocks last year, okay, and the remaining ones in my portfolio are ExxonMobil, Occidental, CNOOC, and Inpex, okay. The US have re-rated massively. Exxon is almost back to 2019 sort of levels right now, okay. The Chinese ones have not. When I bought these stocks, I bought them because you're paying roughly $8 to $10 on their proven reserves. CNOOC has not re-rated at all, despite the fact that oil price is back to $70 a barrel. Excellent results. I'm not sure why. CNOOC is just so cheap, and they're returning a lot of cash as well.
So you're still waiting on that one to play out?
Well, yeah, but I'm being paid to wait because they're paying dividends. And it's not my business to guess where the voting machine will go. I'm just weighing the value here, and I think if I want to be where I want to put my bets is where I think the odds are the greatest in my favor.
Yeah, that sounds very fair. Well, thanks for taking us through all your ideas and your general investment philosophy. Any final words from you?
No, not really. I thought you asked me about crypto, but I guess not.
Well, yeah, well, you might as well throw that in. You don't want to comment on it? You brought it up.
I really shot myself, haven't I?
No, okay.
I'm not a believer in crypto. I'm not an expert in crypto, but I think that it's an interesting sign of our times that people believe that so much money should be put into an asset which they consider to be digital gold. But at the same time, is it for safety reasons or is it for greed reasons? Is it fear or greed driving that movement in capital? Because I'm a little bit confused. People are fearful of US and Fed money printing, which is justification for putting money in crypto. But at the same time, they're happy participants in the growth of the NASDAQ and tech industries. So I think something's got to give, because to me that kind of logic doesn't seem sustainable.
Let's go down that rabbit hole next time. I think there's lots of different investment styles, and people generally stick to what they know. Yeah, thanks again for your time, and hopefully you enjoyed this as well as much as I did. Thanks, John.
Bye-bye. Macro will affect anything, no matter what. But I would argue that in my investment approach, I try not to forecast as much as I can. Like, for example, JD.com. The structure of that business is put there. Negative working capital is not going to change no matter what interest rates does, right? The fact that people prefer to buy their goods online because it's more convenient is not going to change if interest rates rise or fall, okay? The whole structure of a game is set up in a way that you don't know what's going to happen in 1 year or 2 years, but you're pretty confident in 5 years that this kind of business model will win out. And if you pay a low price for it today, sure, there'll be volatility. I didn't know that their chairman was going to get caught on rate charges. That kind of thing tanked the stock. But hey, it's back to where it was before, and it's still cheap. Similarly speaking, the oil and gas thing, you didn't need to forecast what demand would be and all those things. All you need to know was that Chevron, Exxon, CNOOC, and the best oil producers in the world, the cash cost of their production is $40 a barrel. So it's impossible for oil prices to remain in the 20s, given the best operators outside of the Middle East cost $40 to build new reserves. So sustainable oil price has to be in the 60s range, right? Otherwise, the world would lose 70% of oil production. Yeah. And what price were you paying to make that bet? Well, you're only paying $8 for reserves back then in 2020 last year, right? So that bet's got to pay off at some point in time. As long as the company doesn't go bankrupt, that bet has to pay off. There's another soundbite you want to add. You can decide. But I think the unique thing about my investment approach today is that I'm marrying it with concepts of gambling, odds, and maths. I think your typical investor in the hedge fund industry, tends to see the world as either very, very qualitative. Oh, this is a great quality company. I'm going to buy it no matter what price I pay. Or extremely value orientated, saying, oh, look, I'm buying this thing at 8 times PE, etc., whatever. Instead, I try and frame it as a probabilistic set of outcomes, right? Where even if either the odds are hugely in my favor, or where even if things aren't fantastic, I'm going to get my money back. And if they work out just a little bit well, then I'll do I'll achieve a very high rate of return. And I think that's the way I want to do future sizing of positions within my portfolio as well, thinking about it from gambling mathematics point of view.
It's a nice way of distilling an idea